Australia's largest healthcare company lost more than a fifth of its value in 2 sessions, yet the mechanism behind that collapse is not what the headline numbers suggest. CSL did not simply miss earnings guidance. It announced that its core bearing plasma business is now facing structural margin erosion that management can no longer frame as temporary. The critical signal from Monday's update was not the revenue cut of roughly 4.5%, nor the underlying profit decline of nearly 9%. It was that Bearing's gross margin is now expected to deteriorate further in the current year, dismantling the multi-year recovery thesis that had kept institutional buy ratings intact above $150. Bell Potter, citing blood on the street, slashed its price target from $155 to $100. Macquarie cut to $111 after embedding a 20% discount for earnings uncertainty, not because the miss was large, but because management's credibility to guide forward had collapsed. The U.S. immunoglobulin plasma market entered oversupply precisely as Grifols received EU approval for new Egyptian plasma supply capacity, meaning competitive pressure on CSL's most profitable product line will intensify before any normalization is possible. That left the stock near a decade low by Tuesday's open, down a further 3%, with the forward multiple now compressing towards levels last seen when CSL was a fraction of its current size. The question brokers stopped asking, whether CSL could return margins to pre-COVID levels, was effectively answered, and the answer closed a re-rating floor that had protected capital for years. While healthcare capital fled, the same session saw BHP overtake Commonwealth Bank as Australia's largest company by market capitalization, a rotation with a specific cause. Copper hit a record US $14,000 per ton in London on Tuesday, driven by tightening supply from the Grasberg mine in Indonesia, sulfur scarcity linked to Middle East disruption, and AI data center demand compounding baseline industrial requirements. BHP surged 3%, Rio Tinto climbed more than 3%, and Sandfire added nearly 3%, each move causally tied to a copper input price that is now 38% higher year on year. That repricing of resource assets happened on the same day investors were being asked to price in a separate risk, the federal budget. Treasurer Jim Chalmers signaled reforms to capital gains tax and negative gearing, with reports suggesting changes would apply to assets acquired from budget night forward, taking effect from July 2027. For ASX share investors, the critical uncertainty is whether the CGT discount reduction extends beyond property to equities, a distinction the government had not confirmed as of Tuesday's session. Lithium names amplified the resource rotation independently. Chinese lithium carbonate prices climbed to their highest level since 2023, sending Pilbara minerals to fresh record highs and Liontown, IGO, and Argosy minerals sharply higher. The two forces, copper's global supply signal and lithium's Chinese price signal, pointed in the same direction for resource capital, but neither resolved the budget overhang. The divergence between resources and every other ASX sector suggests the rotation was conviction-driven rather than defensive, which means the budget's tax details carry the ability to reverse it overnight if equities are included in any CGT restructure.
The copper and lithium bids on the ASX were happening while Brent crude held above US $104 a barrel, a level sustained because Trump described the Iran ceasefire as on massive life support and rejected Tehran's latest peace proposal as a piece of garbage. Saudi Aramco's CEO stated on an earnings call that the world has lost approximately 1 billion barrels of oil supply since the conflict began, that the Strait of Hormuz disruption is costing roughly 100 million barrels per week, and that oil markets may not normalize until 2027, even after the route reopens, because reopening a shipping lane is not the same as restoring the inventory that has been consumed. That warning landed against a backdrop where Goldman Sachs had already pushed its Federal Reserve rate cut forecast to December 2026, meaning the oil shock's inflationary transmission into the rate timeline is now being priced at the institutional level. The countersignal is that U.S. equity markets, driven by AI semiconductor names, continued climbing toward records, with the Nasdaq touching fresh highs on Monday. The argument being made implicitly by that bid is that AI capital expenditure and cloud spending are independent of oil price transmission. Bank of America directly challenged that assumption, warning that the Iran war threatens both consumer spending and AI capex simultaneously, the two pillars sustaining the U.S. equity expansion. The verification benchmark is the April U.S. CPI print, due after Australian market close on Tuesday. If headline inflation prints above expectations, Goldman's December timeline becomes the floor, not the ceiling, for rate relief, and the valuation premium baked into AI multiples becomes the most exposed variable on the ASX's largest external risk. CSL's margin collapse is already priced. What is not yet priced is a scenario where the AI bid holding Wall Street together encounters the same kind of credibility reset that CSL investors absorbed this week. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.